Hello guys, welcome back. So in my previous video, I teach you the valuation overview, and the only valuation method that BIA uses is the price to sales ratio, and I share with you what is the revenue per share. So now we will put it together, right? Everything together, okay, and I will teach you guys how to calculate a stock's intrinsic value. So as a refresher, if you want to know a stock's price, okay, this is the golden formula. Okay, we take the revenue per share of the company. Of course, we take the last 12 months to have the latest revenue per share, and we times the price to sales ratio. And the price to sales ratio is the average price to sales ratio of the company. And that's we get the how. That's how we get the intrinsic value or the real value of the company. Okay, so here we will guide you on how to use two platforms. Okay, one is TradingView and another one is FinChat. Okay, and of course, I'll be using these three companies as example for you guys. Okay, the Trade Desk, Alphabet, and ServiceNow. Yeah. Okay. So the first things, of course, is this one. Okay, is TradingView. Okay. Now, so TradingView is a free platform also. Okay, all you guys need to do is to just go to tradingview.com. Okay, tradingview.com here. Okay, and then just go and register. Okay, it's free to use. So when you go here, okay, this is the chart that you will be able to look at. Now, there are a few settings that I want you guys to do. Okay, number one, so you go and search the company that you want to do. Okay, let's say it's TTD, the trade desk. Okay, go to the trade desk. Now, number one is the price to sales ratio. So you go to click indicators here, click indicators, just type price to sales ratio. Okay, you can see this price to sales ratio, right? Okay, click the price to sales ratio. When you click it, you will see another column being added down here. Now, this is the price to sales ratio of the company throughout each period. Okay, now remember the formula. Remember the formula here. Okay, this is when the blue color line just now that you saw, this one, this is the price to sales ratio of that particular moment in time. Okay, but if you want to know the value, okay, of the company, right, the keyword here is the average. Now we want to know throughout this period, how much is the market actually been paying, okay, on average to own the company. So if let's say the average is this one, and we see, hey, the price, actually the value, the multiple price to sales ratio is below here, and then that means, okay, this is undervalued. Okay, so let me show you how it works. Okay, now, so now that we know this price to sales ratio is at the moment in time, we want to find the average, right? Okay, so you go to price to sales ratio here, you click this three button. I repeat, okay, when you added the price to sales ratio, you go to this three button here, okay, add indicator. Okay, add the indicator and find what? Moving average simple. Moving average simple. This one. Okay, click here, moving average simple. Because you want to find the average line. Okay, so the next setting you need to do is to go to these settings here. Okay, do you see the SMA here come out already? Simple moving average. Now you want to adjust how many days to take into account the average. Okay, you click the settings button here. Okay, and you click input. The star here, in order not to confuse, to change to red color the red color here. Okay, all right, and now you can see the red color here now. Okay, but this is too near already. 9 days only. 9 days is too near. You cannot see the real average of the company. Okay, all you need to do, okay, you just go to settings, inputs. Okay, generally, you find the days. Each company has a different listing period, right? So you can just experiment 500 days, 1000 days, for example. So let's say the trade desk is, you can test first with 1000 days. Okay, 1000 days, because you want to know on the past 1000 days, what is the average price to sales ratio the market has been paying. Okay, so 1000 days seems okay, right? It's quite short. Okay, if 500 days, I won't use 500 days. You know why? Because 500 days, again, is too short also. 500 days is too short already. So I want to make, okay, the red color line here as short as possible. So 1000 days is good enough. Okay, the longer the better, of course, 1000 days. Okay, because we want to take the whole longer average 1000 days. So it seems to me, okay, on the whole 1000 days, on average, the market has been paying what? 26.2 times. 26.2 times. Okay, and this 26.2 times represents this price to sales ratio average. This is the average here. So now the next issue is we want to find the revenue per share, the last 12 months revenue per share, right? Okay, this is when you need to go to FinCheck. Now, FinCheck, I already teach you guys where to register already in my earlier videos. Okay, so you need to go to the trade desk. Okay, find revenue per share. Just go to the select metrics here, revenue per share here, and you will come out this word, revenue per share. And all you need to do is to just pick the latest amount, latest number lah. Okay, the revenue per share here, okay, the latest one is what? 4.7 times. The revenue per share, the latest one is 4.7. Okay, you can see LTM 4.7. So what you need to do, you just need to times it lah, 4.7. So revenue per share is what? 4.7. So let's calculate together if you want. Okay, so this is the calculator. Okay, now revenue per share last 12 months is 4.7. Okay, you times what? 4.7 times price to sales ratio. The price to sales ratio we found here just now is 26.2. 26.2. So you times 26.2. So the price is $123.14. That is the intrinsic value for the trade desk already. And currently, right now, the price is around 132. So it's a little bit overvalued. A little bit overvalued. All right. So guys, now you can see how nice is it when you have this, this weapon, okay, or this platform, I call it a weapon, okay, to know whether a certain price is undervalued or overvalued. So let's say when you price here, they drop, right? You see what for the past 1,000 days, wow, hey, the market generally paying 27 times, but now this one, the market, wow, that time was only pricing it at 13 times, So hey, it's almost double. Very, very cheap. So now you know this price is very, very cheap. Okay, perhaps you want to take a look. It's very cheap. You buy, you make money. Why? Make money not because I buy cheap, it's because the company keep on performing. And you can see the trade desk here. Okay, why? Because you see the revenue keep on going up. Like that. Okay, keep on going up higher and higher. That's why the price continue to go up. If you get opportunity, you know it's cheap. Wow. Okay, that's when you are confident to go in. Okay. So what is the next one? The next company that we want to continue? Okay, Alphabet. Okay, Alphabet. Let's try. Okay, now that you have everything set up already, very simple. So go to Alphabet. Alphabet. Okay, pick Google. Here, Alphabet. Immediately. Okay, you see like this red line is too long already. Okay, that means we can still take the even longer average. So let's try with 1,005. Let's try with 1,005. Is it okay? Okay, adjusted. Still got a long. Okay, that means the max I will take is 2,000 already. 2,000. So that means for the past 2,000 days, what is the average price people are willing to pay for Google? So you can see there was a very undervalued period here. Wow, the market was actually generally willing to pay around 6.3 times always. Throughout every single year, that means the people are actually willing to pay around 6.3 times. And that time, and this price drop, the price to sales was only around 3.8 or 4 times only. Very, very cheap, 50%. So right now, you can see that's why with the time undervalued, right? A lot of people, if you dare to buy, you can make money. Okay, so now the price to sales, you can see on average is how much? 6.3. Okay, so remember the formula. Okay, the price to sales ratio times the revenue per share. So for example, this one is 6.3, right? So just take the calculator, 6.3. Okay, 6.3 times what? Go to Alphabet. Here, Alphabet. Okay, go find the revenue per share. Okay, here. Very, very simple, right? Revenue per share. Click. So now you know the revenue per share of Alphabet is what? 27.4, the last 12 months. Okay, 27.4. So 6.3 times 27.4. So the price is around 172. And what is it right now? What is the price right now? Okay, 172. Now it's 119. 196 like that. So it's a little bit overvalued. Of course, because the multiple here went up already. So this is overvalued a little bit. Okay, so let's do the final checking. Okay, for another company. Which one? ServiceNow. Okay, let's go to ServiceNow. One final example for you guys. So let's go to service now. Here. Okay, go to service now. Okay, okay, good. 2000 days is good. Okay, because it's very short. It takes a lot of the average of what the market is willing to pay. Judging by this, we all know already it's slightly overvalued already lah. Because on average, people are willing to pay around 16 times here, but right now the market value it at 22 times already. So it's very expensive right now. We know lah. But we want to know what is the intrinsic value. That's when we take the 16.65. Okay, so we take 16.65, 16.65. Okay, times what? Times the revenue per share. We go and find service now. Just click now here. Service now. Okay, type revenue per share. Revenue per share. Click here. We now know the revenue per share, the latest one here, 50.9. So in your calculator, 16.65 times 50.9. 50.9. The real value is supposed to be 847. 847, right? Okay, so let's go back here and see. What is the price now? Wow, 1,000. But it's 847. So it's a little bit overvalued. How nice that time if you know this. It's been paying around on average 16, but one time the market here dropped. Wow, okay, the market only value it at 10 times. Wow, it's close to 40%, undervalued here. So right now it's a bit overvalued already lah. But the gist of it, okay, I hope you guys understand how to value, okay, the company already. Very, very simple. Okay, so this is the end of this video. So the next one, not only that, not only you all know the valuation of the company, you must add another, okay, item is what we call margin of safety. Very important. Okay, and what you want to know what is this margin of safety? Okay, look at my next video. Okay, see you there.